Our next guest says the biggest bubble ever is about to burst. Let's bring in Julian Emanuel, Chief Equity and Derivative Strategist at BTIG. Julian, I'm glad you're here. I'm worried about this biggest bubble ever about to burst.
You actually shouldn't be worried, Melissa, because if it bursts in the way we think it's going to burst, it's going to be in a positive way.
Wow.
So essentially, think about this. 7-8 years ago, everyone was talking about that great rotation trade where we all were going to sell bonds at 3.5–4% yields and buy stocks. Well, here we are. We're negative 70 basis points in Germany. We're 1.5% in the U.S. We're at all-time highs. People are very worried about recession. We think that the policy response by both the Fed, the European Central Bank, and ultimately the White House and the German government is going to be enough to cause the bond bubble to burst, and we're going to get a resumed rally in the stock market.
You're banking on the bond bubble bursting, though, at the long end of the curve.
Yes.
So the curve will steepen.
Yes, and actually, this may seem counterintuitive, but it really does work in practice. If the Fed is successful, and we think they're going to cut 50 basis points on September 18th, surprising the market, in a positive way, because we don't think that the story that, the Fed knows something that the rest of the world doesn't know applies, because they've said it a number of times that they don't know anything more. But that is likely to stoke inflation expectations, which will cause long yields to rise. And in fact, one more point. What was interesting about today's action is you haven't seen this happen very often, but yields plunged and the price of oil rose and inflation break-evens rose. Obviously, there's always lots of noise in that, but that's not a bad sign.
So appreciate your always very balanced approach to this. So you're talking, the headline sounds scary, but you're saying actually there's a blessing in here. But key to that is you're saying that ECB policy is going to work. Our yields are getting dragged lower by bond yields, not because our economy is going straight downhill.
No question about it. But what I think the change in the last several weeks is that the Germans are waking up. Their economy is about to go into recession. They are likely going to take action. And look, we've seen the response in the market to A, the inversion of the yield curve, and B, to the president's tweets in the last several weeks. All it takes is actually some form of daylight. And against this September 1st tariff deadline, we're going to know very soon whether there is any daylight forming with China to really sort of send the bond market moving in the other direction. Things are very, very extended.
So, Julian, 50 basis point cut in September is not a mid-cycle adjustment. It is a rate-cutting cycle here. And what is your thoughts about the stock? I know what you just said about the stock market, but generally, if you look at the last 20 years, it has not been positive for stocks when we start cutting rates, especially from such a low level here.
There's no question about that. And I would say that when they cut rates, whatever they do, and again, we do think it's 50 on the 18th, Powell will be very careful not to categorize this as a mid-cycle adjustment or a cutting cycle, just something that they're doing in response to the accumulating stresses in the global economy and to mitigate the risks of clearly, even if the trade war shows some daylight between now and September 18th, you've still got Brexit, an extremely contentious issue, as well as Iran out there.
Julian, good to see you. Thank you. Julian Emanuel of BTIG.
So we just goodbye the guest, so I will not ask Julian a question because I'm
following the rules.
Following the rules.
But
what will I say is, if Julian's right, and I'm not bringing him back, I would think that the banks would be screaming buys under that scenario.
Yes,
now, I don't
curve.
necessarily agree, but if the folks at home agree with Julian,
I'm going to give you a special dispensation. Julian.
Oh,
he's back! Oh, my God.
I didn't know you could do that.
That is magic.
I have the power to suspend the rules.
How you left.
Quickly, are banks a buy in this?
We think they are.
Okay.
And furthermore, we actually think that the market's telling you that the cyclical areas will need to work for us to be right that the market will go to 3,000 by year end.
Thank you, Julian, once again.
Once again.
There you have it.
I dare you to bring him back, Dan.
No.
Wait. But what market is he saying is telling us that? Because the cyclicals, you would think that the banks are obviously pretty cyclical. We just saw industrials turn down. We saw consumer confidence really great, but we see the bulk of retail to look like horrible. Yeah, so, I don't.
Well, what about financials, though? You've been more negative and mostly right on this whole thing. So Do you agree? I mean, is that something that
No,
stands
I think,
out for you?
I think that the globe right now and what central banks are doing, we are like literally on the precipice of seeing what an experiment unlike any in the financial universe has seen. So we are going to zero, okay? Our rates are going back to zero from 2.25, and every central bank is tripping over each other to get their own rates lower. So to me, I have no idea what happens, but all I can tell you this is that the Japanese bank index, the topics, okay, 30-year lows. The Euro Stocks bank index, 30-year lows. And our banks act like dirty, rotten, you know what, and I don't know what comes next, but it's not going to be making a new high anytime soon.
Let's get the other side of this. First of all, our banks have outperformed Japanese banks and European banks.
Fine.
I don't even mean in this cycle, which they clearly have, but I mean in other cycles, especially after Japan.
Our banks have, yes, they have.
So back to the Fed. If this was a mid-cycle adjustment, whether the Fed is going to do that or not, that's very bullish for equities, just to be clear. It means a Fed that got off of the hawkish tone is actually, if anything, in your corner with a market that's an economy that's not falling apart.
Mel, if Julian were still here and we could bring him back a second time.
Actually, no, they gave him the hook.
He's gone now.
He's really gone.
But the question would be, he talks about they are dead set on the 50 basis point cut. That's what it sounds like to me. What if it's not that? I mean, is that going to be something that causes some turmoil with the markets, that it's not enough? I mean, I think we already went through that cycle where a lot of people were hoping we'd cut by 50 basis points this last time. We didn't. So what about that? What if they don't do it this coming time? Is that a negative for the markets?